Hello and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, to be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Fraser Wilkinson, investment manager based out of our Leeds office. And this week, I'm pleased to be joined by Maurizio Carulli, our commodities expert, and Richard Carter, our head of fixed interest research. Good morning to you both. Well, it's been a tumultuous period on the global stage, and all eyes are on the Middle East once again. And this is having an effect on commodity prices and particularly the oil price. So, Maurizio, with the recent tensions in the Middle East, focus is once again on the oil price, which had been falling, but is now starting to rise again. Can you explain to us why it's rising? Is Iran a major source of global crude oil?
Thank you, Fraser. Oil price has declined in recent months due to increased oil production by OPEC, as well as uncertainties about the global economic growth for this year, due to the imposition of US import tariffs. Since Israel started the military action against Iran past week, oil price has passed from $65 per barrel to $74 per barrel today. And this is due to concerns about possible restriction to Iranian oil exports, which represent a significant 1.5% of global oil production, as well as the possible closure of the Strait of Hormuz, where about a third of seaborne transported oil passes through. I must stress here that so far until today, there has not been any kind of strikes to Iranian oil export facilities, and there is no indication that of any restriction to the Strait of Hormuz passage.
Thank you. Well, that's something we've got to keep our eye on. And generally, oil production, what's the likely future for oil production? Could other countries perhaps ramp up their production, and will they?
Yes, well, OPEC has about 4 million barrels per day of spare capacity, which is about 4% of global total production, and this can be certainly ramped up, but will require some time. So, as long as the military action will continue, it is likely that the oil price will remain at elevated level, albeit temporarily.
Yes, and I guess that might have an impact on inflation, which we'll come to in a second. But how do these changes in the oil price affect the big oil majors like Shell and Exxon that we focus on in our investment portfolios?
Yes, oil majors will receive a one-off boost to their cash flows since the price realized from their sales of oil will be higher. However, unless the conflict will extend and become prolonged, it is likely that over time oil price will revert back toward the 65 dollars per dollar per barrel. So again, barring a further escalation, the extra cash flow benefit will likely only affect a quarter or two.
And with our illustrious leaders in the UK, Ed Miliband, focusing on net zero, I wonder how the major oil companies that we do invest into, how do they fit into the net zero agenda? Will the likes of Shell and Exxon be around in the coming years and decades?
Excellent question, Fraser. In terms of demand, it is important to differentiate between oil demand and gas demand. Oil demand is expected to peak in the early 30s due to the increase of usage of electric vehicles and the development of more renewable power. Gas demand instead should continue to grow until at least 2040 and may well be longer. So oil companies will continue to be around for quite some time, no doubt about that. In addition to that, it is important to remember that oil reserves are a depleting commodity. Every year, about 5-6% of the existing reserves of oil are used, and therefore the role of oil companies also to develop new oil fields to compensate for that sharp reduction until the oil demand and gas demand will be out there, which again will be for quite some time.
Good. Oil prices and energy prices in general do have an effect on inflation as well. So, for turning to Richard, we've been scarred a little bit after COVID and the quantitative easing and prices going up quite a lot, and we have had quite a focus on trying to get prices down through monetary policy. But inflation has started to creep a little bit back up recently, and the recent CPI print was 3.5%. And I guess the target is, as ever, 2%. How do recent effects affect the inflation outlook? And do you feel that inflation will rise further from here?
Yeah, you're right, Fraser. We kind of thought we'd seen the end of worrying inflation numbers for a bit, and then here we are again. It's all happening. I mean, the situations Maurizio talked about in Iran and Israel. For now, it seems just about relatively contained in terms of the oil price, but that could change in a heartbeat. So markets are watching that closely. I mean, we are seeing a spike in inflation at the moment. It was very well telegraphed. We knew this was coming. It was partly energy related, but also water bills and airfares and mobile phone charges and sort of national insurance contributions. Basically, everything that could go up in April did go up. I don't think, though, leaving aside Iran and Israel, it shouldn't get much worse from here. And we're going to be around 3.5% for a few months, and then after that, it should come back down towards 2%. So there is some reason for optimism, but as 2025 keeps giving us new things to worry about, whether it's tariffs or war in the Middle East, clearly, if Iran were to close the Straits of Hormuz, it really would change the inflation outlook for the worse. So let's hope that doesn't happen.
Well, with all the one-off reasons for the increase, hopefully transitory might be the word again. We've had a few interest rate cuts in the UK. Given this inflation outlook and the hope that the inflation will come back down a little bit towards target in due course, do you think there will be more interest rate cuts this year, given the inflation backdrop?
Yeah, there should be. I mean, actually, before Israel and Iran, the conflict started again, we had seen some sort of fairly sluggish UK data. Actually, growth wasn't great recently. You've had unemployment starting to pick up a bit, wage growth come down. So all that was adding up to more rate cuts this year. At least a couple more. Nothing this week at the next meeting. But certainly there was a potential for a rate cut in August and maybe another one after that. So I still think we'll see that. But as I say, the risk is that suddenly we get a spike in oil to 100, and then the Bank of England has to kind of back off. But for now, markets still expect one or two more rate cuts this year.
And just for our listeners' benefit, of course, interest rate cuts means that the risk-free rate is lower, and that makes risk assets a little bit more attractive. So it could be helpful to portfolios, all things being equal. Richard, deficits in the UK seem to be growing, and as you've touched on, some of the economic data has been getting a little bit worse. Inflation rising, the economy seems to be flatlining. Do we have a feel for the market's early impressions on our current government? And obviously, we're thinking about comparing which countries to place life savings in at the moment.
Yeah, it's a difficult one to answer, actually, because how do you measure a market's faith in the UK? We can talk about currency maybe in a second, but I think when you look at deficits in the UK versus America, we're in a better situation than they are at the moment. At least the government's talking the right language about trying to get debt under control. It's just difficult. I mean, you just had to look at the issues around the winter fuel allowance. I mean, those are relatively small sums when it comes to it in terms of the overall budget. But even trying to do that was politically very, very difficult. And that's with a government with a large majority. So it just shows that getting these deficits under control is easier said than done. The market does think we might see tax rises in the autumn. I think one way to look at it is, bond yields versus other countries. I mean, yields in the UK are fairly similar to that in the US. In fact, long-dated yields are higher here than they are in the US. That's not just down to deficits and stuff, but certainly I think markets are pretty sceptical that the UK will be able to get the deficit down, very quickly.
And I guess related to that is currency rates. Having had a few US holidays in the past, I'm quite disappointed to see sterling being so strong at the moment. Could have got a lot more dollars. And since the election in the US, it seems like sterling's been on a bit of a tear. Is the UK seen as a bit more of a safer pair of hands, or are there other reasons for the sharp currency movements?
I mean, I think, deficit, as I say, deficit's still a problem, but at least we're trying to do something about it. Whereas the US just sort of seems to think it's somebody else's problem, and they can just go and sort of cut taxes and spend money at will. And the dollar has been weakening, not just because of that, but because also the whole tariff thing and the whole sense of, do people really want to just put their money in the US, whether it's bonds, currencies, or equities? For the last few years, that's been a no-brainer. It's been the thing to do. Now, with such a sort of uncertain policy making out of the White House, you just think maybe this isn't such a good thing to be doing. So the dollar's weakening. Sterling has benefited, definitely, but then so is the euro and quite a few other currencies. So I don't think it's sort of a vote of confidence in the UK, but maybe we look a better place to put your money at the moment than perhaps the US.
Yes, and potentially our king is a little bit more stable. Well, thank you both for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, please tap the subscribe button. We will be back next week, but in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And finally, do you have any questions you'd like to ask one of our experts for the next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. That's it for today. So thank you, Richard and Maurizio, for your time today, and all of you for listening. See you next time.